hedging partial shares. Different approaches to hedge or protect a position if you have less than 100 shares. This comes directly from Pavol. He wants to know, what are good hedges for partial positions? Would a married put be a feasible hedge for a position if, for example, I had 50 shares of Microsoft? I believe it would be, but we're going to take a look at that, of course, and some other ideas. Could there be some combination of put strike and expiration that would still work? All right, now what are we talking about here with a married put? Following the radioactive trading techniques, and then discussed in the blueprint course at radioactivetrading.com, the way I'd set up a common married put, I'd protect long-term using that proper structure. So today I might have bought shares of Microsoft at 280.75. I think it closed at 277 or 276, but buying shares of Microsoft at 280.75. I'd go out maybe to October or further, but I could buy an October 300 put for 34.75. My total investment goes up to 315.50, but I'm guaranteed to get 300 back no matter what happens on the stock. So the maximum risk on the position is 15.50 or 4.9% on the position, about a 5% risk. This is the static married put. That break even of 315.50 is only at expiration. If I hold it all the way to October expiration, make no adjustments on the positions, in that case, except no dividends, then I'd have the full loss of 4.9%. The curved red line here shows us at the halfway point, I could start making a profit at 300. If the stock moves up 3 or 4 points next week, I'll be up maybe a point or two on the position. All right. So that's the static married put that we use. And then we use the 12 different income methods discussed in the blueprint off of that. What about only 50 shares? 50 shares, this gives you a synthetic strangle. We have 50 shares of Microsoft at 280.75. We buy the same October put. Sorry about that. About the same October put for 34.75. So we now have a new cost basis that went up from 14,037 originally invested in Microsoft up to 17,512. But because we only have 50 shares and our put represents 100 shares per contract, we can profit to the downside and we can profit to the upside still as well. Although this is the approach and the structure on a put that I would use for long-term holding with 100 shares or a one-to-one link to the position, 200 shares, 2 puts, and so forth, this structure is probably not the best hedge that you'd want to use. Pavol, in this case, you're bullish on the stock. You bought 50 shares of the position. You're putting up about $3,400 for this protective put position, almost $3,500. Let me say it correctly. Your upper break even goes up to 350.25. Yes, that's at expiration. But you see here, even if the stock goes up to 300 at the halfway point, you're still down about $500 when you'd be up about $1,000 on the position. With just the 50 shares, a 20-point gain gives you $1,000 there on just your position. So this didn't help the upside at all. Your break even is moved way out here. And yes, you can still profit to the downside in this case. But you need the stock to drop to almost 250. That's at expiration. But even here at the halfway point, this far out, you're down to 260. It's helping you not lose as much money. Absolutely. But that's a pretty big decline. Well, it's 30 points. It's about a little bit more than 10%. That's still a big decline, but it would work as a hedge in that situation. What we might want to consider, of course, in lieu of the married put setup that we would use on a longer stock holding position, with 50 shares of stock, let's go cheaper. Okay, we're going to go shorter term, maybe 60, maybe 70 days out in time. We're going to look for something that's a little bit cheaper, a $10 put option here, buying the 260 put out of the money in this situation. We paid $280.75 for the stock. We're adding $960, so naturally the break even is going to move up. We're going to need the stock to move more because we're going to start losing on the put. It probably only has a 0.4, 0.2, 0.35 delta, somewhere around there, but it's a 2-to-1 ratio, isn't it? We've only got 50 shares, and the put represents 100 shares. So we're gaining 0.5 delta here, but losing 0.35 delta, so we're not getting as much profit as the stock is moving up from our initial purchase price, even closer in at the halfway point. but it still sets up that kind of strangle. However, you see here the break even is pretty steep. We did the 260 put for a cheaper price. The insurance doesn't kick in until 260, and that 2-to-1 delta ratio working in our favor really doesn't get us to profitability until we start dropping below 225, getting into 220 range. That's now a 60-point drop. We're talking about almost a 20 to 25% drop on the position in order to get the benefit of having the synthetic strangle on the position with that cheaper out-of-the-money put. At the money put, of course, is going to cost the highest time value. So that might not be the best hedge because it's going to be a decaying asset as we go forward. Now, what about a cheaper approach? Rather than just buy the put, what about a Bear Put Debit Spread? Here we're going to straddle the position. We're going to straddle the current stock price. We're going to buy a slightly in the money put, still out to July to give us some time for the reasonable hedge. And we're going to pay about $19.15 for that. But at the same time, we're going to sell an out of the money 275 put for $14.70. So we're only putting in an additional $450 or so for the position. And if the stock falls below 275, we'll get 10 points back on our Bear Put Debit Spread, so a profit of roughly $550 or so on that position. To help hedge the loss we're taking on the 50 shares. Well, how does this look together? It looks pretty good, actually. The upper break-even is increased again, so we have these two break-evens here. But if the stock falls even slightly down to 275, down to 270, we're still in sort of a profit range. We're still looking good. But because we're in a Bear Put Debit Spread, as the stock starts to move up, that put that we bought is declining. And our 50 shares don't counter the loss on that put and the loss of the 450 we put into the debit spread until you get up to 289.70. Now, this is still 77 days out to work as a hedge, but it does give an effective hedge. So now, even if the stock's down here at 260, you'd only be losing $500 on this position. Whereas with your 50 shares of stock, you might be down 1,000. It's about a 20-point drop from where we bought in, times our 50 shares there. So that might be, we're still doing what we want with this hedge in this position, but it still does take a lot of risk if it really exceeds our expectations to the downside. So the Bear Put Debit Spread is another approach than just the married put. It's a cheaper alternative. And of course, you can't do a covered call against 50 shares of stock. But what about a Bear Call credit spread? We can sell an out-of-the-money call. Yes, we're bullish on the stock, but maybe the next 14, 15, 20 days, I don't think the stock's going to reach, say, 300, 305. So I might be able to do a shorter term, deep out-of-the-money Bear Call credit spread, selling the 14-day out 300 strike, getting about $1.20, and buy the 310 for 45. So we're going to get about a 75-cent net credit on our 50 shares. Against our 50 shares, we bought at 280.75. What is that going to do? That's going to lower our break even down to 279.25. And means we're going to have more profit to the upside. We get this little hiccup here. This is similar to income method number 6 in the blueprint against the married put structure. But we leave the upside open, though there is that little gap there if the stock is between the strike prices where we'd have to buy to close or roll out that spread position. This is something you can do against partial shares as an income. You do have to put up, in this case, the extra $1,000 to cover the margin requirement of the Bear Call spread. It's not effective as a hedge as a Bear Put Debit Spread and that we saw. And the reason why is I can't do the at the money with the Bear Call because I'd be selling an in the money call in this case where I might be obligated to deliver 100 shares of stock and I only have 50. So I don't want to do that other structure where that sold 275 put in the Bear Put Debit Spread. I don't want to sell the in the money 275 call. It's out of the money for that at the money Bear Put spread. Be in the money on the call, and I don't want to take on that obligation early if I only own 50 shares. So you got to go further out. You're only generating $1, 75 cents, 80 cents or so, but that helps work to lower your break even. If you do it consistently over the life, you're going to lower the cost basis on the position. You only have to allocate an extra 500 if you do a 5-point spread, or an extra 1,000 in that case as well. The hedge is limited, though, to just the net credit you receive, whereas the Bear Put Debit Spread gave you a little bit more. Now, a popular approach that investors always like to use as a cheap, effective way to maybe profit to the downside, but still have profit if they're right without putting up a whole bunch of money is this ratio back spread idea, a put ratio back spread. In this example, I might sell an at-the-money 280 put. There's different ways to structure this, but we're going to look at this one. We could sell the at-the-money 280 put and get 1810, and then we're going to buy two lower strike 250 puts in this case at 775. So we're going to take an 1810 and pay out 1550. We're going to get a net credit of 260 in this case. But this is a bull put credit spread with an extra put. So I still have to cover the margin of this 30-point spread. Why did I choose these strikes so far apart? To get a credit. If I went to the 255, it was a small debit of 20 cents. Not bad, but it's not what we want. The standard ratio back spread, you want to see a profit even if you're wrong, but have the potential to have profit if it really runs against you. But in this structure, the ratio, put ratio back spread, or any kind of ratio back spread, this is what you get here. You get Death Valley. Okay, that is a wide range of profitability. Now, we're kind of right at the money here, but the stock fell there. But look at these break-evens, 222 to 270 cents, 50 points in no man's land. Okay, that's a tough one on these types of positions. With the 50 shares of stock, does it look better? Not really. That 260 really does help. That 260 net credit you'd get would really help your cost basis. You're going to lower your cost share down to 278.52 from the 280.75. That's pretty nice. The stock takes off. We still have an unlimited upside profit potential on the position because everything was paid for, and the puts will just expire worthless. You don't have any obligation in this case. However, is it working as a hedge? At 260 here, we're at about a $2,000 loss. Why is that happening? Because now you're losing on your 50 shares of stock, and you're losing on this short put that we sold at the money to do the put ratio back spread. The insurance doesn't kick until here, and by the time that does, the maximum loss is about $4,000 if we're right at about 250. It'd only be about 1,500 with just the 50 shares. I think in this case, that Bear Put Debit Spread that we saw might be a better hedge against the position, a cheaper cost alternative than doing the married put, which really extended out your upper and lower break even, especially even if you went shorter term with a cheaper price. So the conclusions. The married put gives a good strangle structure if you think there might be wild swings on the stock position and you're looking for a hedge. But I think the Bear Put Debit Spread might be a better approach to hedge this partial position. Yes, you're going to have to pay the debit that we saw, $450 or so, to enter the position, but it gave a good hedge to the downside without too much damaging the upside, meaning it did increase that break even by another 6 or 7 points to the upside. But again, you could still profit to the upside if it went above 289. The Bear Call credit spread is good idea. It's an idea to use to generate income since you can't do a straight covered call on the position. You can just put up the margin requirement, Pavol, for the Bear Call credit spread, but the hedge is limited to just that net credit you receive, and it does increase the loss if the stock moves up potentially with that little bump we saw. Not the loss, but you're going to miss out on some profits in that case if the stock really ramps up and is between the strike prices of the Bear Call spread against your 50 shares of stock. Put ratio back spread did not look good. I put it in there because I had a feeling someone might ask the question when we were discussing these positions in that case. So I just wanted to cover it, but it does not look good as a hedge on partial shares. It's okay to use for full shares, of course, don't get me wrong. But in that case, this is what we look for. And I don't know how far this is progressing. Look soon. I think direction applied in February for this. To have these, and I think they're working on them. Single stock ETFs are coming out, and they're coming out on the ones that you'd expect. Amazon, Alphabet, Microsoft, Facebook, I believe, Apple, of course, if I didn't already say that one, and Tesla, I believe, as well. And these are going to be just like what we have for SPY. You're going to have ultra, 2x, and potentially 3x bullish Amazon ETF, just 3 times Amazon's movement. And I believe they're going to come out with the inverses of those two. Why is that important? An inverse ETF on Microsoft, that would be a good hedge. You could just buy maybe 10 shares of Microsoft in that situation. I'm sorry, the Microsoft ETF, the inverse ETF, and that could work as a hedge for you. You don't have to hedge the whole position, right? You're not doing the whole hedge there. You're not buying, another 50 shares of the inverse ETF on Microsoft. You're just buying maybe 5 or 10 shares so that if you expect a 10% loss, you might negate half of that with the gain in the shares of an inverse single stock ETF. You could also use the inverse QQQ. Right, so Microsoft tracks the Qs, the texts get routed. You could just buy maybe 5 shares of the inverse QQQ ETF Pavol, and that would work as a hedge as well. You don't need to buy 50. You might be able to just buy 5 shares, or 10 shares of the position. So I know they're coming, just don't know when. Okay, so that's another alternative, but you could use the inverse QQQ Pavol if you're worried about Microsoft sliding, which would, if the NASDAQ sliding more, the tech routes, that could help you hedge the loss in the position.